Chapter 13 examples for cost accounting. In Chapter 13, we talk about various costings such as target costing. In target costing, this is when the market sets our price. And so in order to get a guaranteed gross profit margin, we have to reduce our costs or create a target cost. So in this first example, we have a equipment that we make and we sell a part for $610 and our sales volume averages 25,000 units per year. Recently, our major competitor reduced the price of its equivalent unit to $550. Because we're in a very competitive market, unless we meet their new price, we'll lose market share. So we've decided to drop the price, but we would like to still keep our current profit. So what is the target cost for maintaining our current market share and profitability? So we have our new price of $550. And we want to know what our current profit per unit is. To do that, we need to know what our current costs per unit. So our current cost per unit, we have actual cost of $13,715,000 for 25,000 units. So we take that amount divided by our production of 25,000 units, and we get a current cost of $548.60. Our current selling price is $610. So our current profit per unit is $610 minus $548.60. So our target cost is our new price minus our current profit per unit. So our target cost for this is $488.60. So we would go back and look at how can we change our production or even change this product to get our current cost of production from $548.60 down to $488.60. And we can see in some of these examples, when we really look at our costs, we can see that we went over on rework, machine setups, and inspection costs. So that would be one of the first places we would look to reduce costs. So we have we spent more on direct materials than what we had budgeted. We spent more on labor than what we had budgeted. And we spent more on inspection, machine setups, and returns and rework. So one of the things that we might want to look at is the quality of our direct materials causing all of these returns and rework? And is the returns and rework causing the extra cost in inspection and the extra cost in labor? So we would want to re-engineer this product to drive those costs down. The next example that we're going to look at is a life cycle cost, where we want to look at all of the costs along the life cycle and set our target cost. In this case, it's going to be for return on assets. So we own a canoe rental. We rent canoes at one station, and then we drive people back to their vehicles after they get out of the river. We have an example of what all of our costs here for fixed costs and variable costs. And what we're trying to find out is what do we need to charge for rentals if we want to make sure that we have a return on assets of 20%. So we have a target life cycle return on investment of 20%. Our investment is $25,000 that we spend for our canoes. And we believe that every 10 years, we're going to have to spend $25,000 to buy additional canoes. So in order to make that return on investment and to make all of our costs, what do we have to charge per rental? So we're going to look at all of our various costs. What are our total fixed costs, total variable costs, we add those together and that gives us our life cycle costs. Then what is our target profit pre-tax? What is our markup? What do we want for life cycle revenues? And that gives us our target price per rental. So first, what are our total fixed costs? We have a selection here of all of our fixed costs. We're going to add them all up. And we have total fixed costs. Now for our total variable costs, we want to add up all of our total variable costs and then take that amount times the 6,400 rentals we have every year to get our total variable costs. We add those together and that is our total life cycle cost. Our pre-tax profit is our investment times 20%. We want a 20% return on our $25,000 investment. So we want a $5,000 pre-tax profit. So now we need to take this amount, $5,000, divided by our life cycle cost to get our markup rate. Our markup is 7.46046. We take our total expenses, so our total life cycle cost, times 1 plus our markup percentage, and that gives us our projected revenues that meet both paying all of our costs and give us that 20% return on investment that we want. We take our total revenues and divide by 6,400 rentals and get a target price of $11.25 per rental. In this example, we're looking at the quality function design for a sailboat. So in the quality function design, we combine value engineering with customer ratings. So we have information that our customers rate safety and comfort as the two most important things in their boat buying criteria. Their other criteria are performance and styling, and they are not as highly rated as safety and comfort. Our total costs we have broken down here. So our team engineer and our sales manager studied all of the costs and the different components that are part of a boat. So we have 5 different cost pools for this boat. And when we add up the total costs, we spend 30% of the cost on the hull and keel, 17% on the rig, 15% on the sails, 15% on the electrical, and 23% on other. We then have broken down design things for safety, styling, and performance and comfort. So we have customer requirements for safety, styling, performance, and comfort. And then we have what our current ratings are for each one of these items on safety, styling, performance, and comfort. So we take our customer rating times our current rating to weight them. So here we have our customer criteria value is 34%. And the styling rating is 13%. Our performance rating is 20%. And our comfort rating is 33%. So we're going to weight our safety engineer evaluation times our customer's belief of what is more important to get an importance index. So we take the safety rating for our customers times each item here. And we do the same for styling. Performance. And comfort. We now have an importance index for each of the components of our sales boat based on our customers' criteria. So we bring our importance index information down here, and we compare it to our cost index review from above. For the value index, we take the customer important index divided by the cost index to determine how important the customer ranks each one of those things in value for what they're willing to pay. We then look at that the hull and keel and the standing rig are given the most value, and the electrical is given the least value in what customers term for things of value that they're willing to pay for. We would go back to our original cost, and then when we're doing our value engineering, we know that we need to spend more money on the standing rig, given the importance to customers, and less money on the electrical. So that gives us a ranking for where we can start looking to cut expenses. The last example in this chapter is based on theory of constraints. In theory of constraints, we only have so many hours of working time per week in order to make items. So we want to look at what is the most beneficial production schedule for us based on this limited constraint of direct labor hours. We have a lot of information here. So we have employees work a 40-hour week with 5 hours off for breaks and a 4-hour week per month. We also have on assembly, we have 175 hours of working time per week for 4 hours a week. Our other information is here for the other items that we do. We make end tables and sofas. Our current demand is 400 end tables and 150 sofas. We do not have enough direct labor hours to meet all of them. So we need to find where our constraint is. So what part of the production process is causing our constraint? So we want to know what the time required for each product is. So how much time do we need to make a table? So for our labor, we would have the time required for each divided by the availability of 60 minutes in an hour. And we do that for every item. Okay. So we have for the table, how much time we have required. Now for the sofa, we do the same exact thing. How long does it take to cut lumber? Divided by 60 minutes in an hour. Then we want to know how much time is available to us. So how much time is available for laborers to work on cutting lumber? So we know that we have 35 hours a week because we have 40 hours a week minus 5 hours of training. So 35 hours a week times 4 weeks per month, and then we have 2 people cutting lumber. So we have an availability of 280 hours for lumber. For sand, we have 35 hours a week times 4 weeks a month times 2 people sanding. For assembly, we were told that we have 175 assembly hours a week times 4 weeks per month. For staining, we have 35 hours times 4 weeks per month times 2 people that are sanding. And for cutting fabric, we have 35 hours times 4 weeks per month times 1 person cutting fabric. So now we want to know exactly how much time do we need to meet demand. So our demand for tables is 400 a month. So we would take 400 tables, lock that cell, times the amount of time it takes to do each activity. And for sofas, we have 150 demanded times the number of time it takes to perform labor for a sofa. We add those together. And that tells us how much total time we need for production to meet demand. We calculated our time available up here. So we take our time available minus the total time we have for demand. And we find that our constraint is in staining. So we have a higher demand for total hours of staining than we have available for us. So there are different things that we can do. One, we could hire another person in staining to increase the number of hours to make demand. The other thing that we can do is look at our production to make sure that we're using the highest throughput per hour for that constraint. So we have the price of tables and sofas, the cost of materials. We take the cost of materials minus the price, and that gives us the throughput margin. Our constraint is staining. So we're going to look at the amount of time that each item spends in staining. So a table is 0.8 and a sofa is 0.3. So then we're looking for our throughput per hour. So 150 divided by our throughput. 200 divided by 0.3. So the sofa has a higher throughput per hour. So based on the available amount of hours we have to stain, it is financially beneficial to us to create all of the sofas before we put any of the available hours on tables. So we're going to determine our production level based on that. We're going to produce all of the sofas. This is going to use up, we have 150 sofas times 0.3 hours per sofa. So that is going to use up 445 hours of staining. That gives us, if we have a total of 280 hours available for staining, and we use 45 of them to make sofas, that gives us 235 hours left to produce tables. Okay? We take that 235 divided by 0.8, and now we know that we can produce 293 tables. We have to round down. If we make 294 tables, somebody has to put in overtime. So 293 tables. We then have the throughput per table or per unit that we have up here. So we take the production times the throughput per unit, and we get our total throughput for monthly production of 73,950.